Hey everyone, and welcome. Have you ever wondered how traders bet against a stock, but without taking on some kind of crazy, unlimited risk? Well, today, we're going to break down a really popular strategy for doing exactly that. We'll start with the basics of what a put option even is, and then we'll build our way up to a clever technique called the bear put spread. Let's jump right in.
Okay, so here's our roadmap. We're going to start with a concept we all get, insurance, to really understand what a put option is all about. From there, we'll actually build the bear put spread, we'll run the numbers on profit and loss, and you'll see exactly how it puts a hard limit on your risk.
You know, to really wrap our heads around how a financial option works, we don't need to stare at complex charts and formulas. Not at first. Let's actually start with something we're all familiar with. Good old insurance.
So how in the world is some complex financial instrument like an option anything like your car insurance policy? Well, it turns out the core idea is exactly the same. It's all about protecting the value of something you own, an asset.
All right, so first things first, you need an asset. In the financial world, that might be a stock, right? But for our example, let's just say it's your car. This is the valuable thing that you want to protect.
Let's put a number on it. Let's say your car is worth a cool $100,000. Naturally, you'd want to protect that value.
To do that, you pay a relatively small fee, right? The insurance premium? Let's call it $5,000. Now that payment buys you a really powerful guarantee. It buys you the right to be protected if your car's value plummets.
So, if the worst-case scenario happens, your car gets totaled, its value drops to zero, the insurance company steps in and pays you the full $100,000. That premium you paid protected you from a catastrophic loss. And believe it or not, this exact same logic applies to a put option. All right, so let's take that insurance idea and bring it over to the stock market. This is where we officially meet the put option.
So, a put option buyer is basically the car owner in our story. They pay a fee, it's called a premium, and in exchange, they get the right but not the obligation to sell an asset, like a stock, at a price they agree on beforehand. Now, why would they do this? Because they believe the actual market price of that stock is about to fall. It's literally financial insurance against a price drop.
And for every single option, there are two sides to the coin. And this table just lays out that fundamental conflict perfectly. On one side, you've got the put buyer, our car owner. They pay a premium because they think the price is going down. The most they can lose is that premium they paid. But on the other side, you've got the put writer. They're acting like the insurance company. They collect the premium, and they're betting the price will actually go up or at least stay the same. Their profit is capped, but their potential loss if they're wrong, well, it's huge.
So you might be thinking, okay, I get it. Buying a put is like buying insurance. Why would I do anything more complicated? And the answer really comes down to two things, cost and precision. To cut down on the premium they have to pay and to really nail down their risk, traders use something called spreads. Let's look at a classic, the bear put spread.
Okay, let's make this real. Imagine an investor is bearish on a stock called Box. That's just trader speak for saying they expect the price to fall. More specifically, they think it's going to drop below $20, but they probably don't see it completely collapsing much further than, say, $14. This very specific view is absolutely perfect for a spread strategy.
Now, to pull this off, the investor actually makes two trades at the exact same time. So let's break down how that works, and most importantly, let's calculate the total cost to get into this position in the first place. This is the whole shebang right here. It's a two-part play. First, they buy the put option with a $20 strike price. That's their insurance policy that pays off if the stock drops below that $20 mark. But to help pay for that insurance, they simultaneously sell the $14 strike put. Now, this move brings in some cash, but it also means they have an obligation if the stock drops all the way below 14.
All right, let's follow the money. First up, the cost. They bought 8 of those $20 puts, and the premium was $6 each. So, 8 times 6, that's $48 going out the door. But remember, at the exact same moment, they're bringing cash in. They sold 8 of the $14 puts and collected a $3 premium on each one, just like an insurance company. So that's $24 coming back into their account. So what's the bottom line? They paid out $48, but they took in $24. The net cost to put this entire strategy on is just $24. And here is the absolute key. That $24 isn't just the cost. It is the absolute maximum amount of money they can possibly lose on this trade, locked in right from the very start. Okay, the trade is on. We've spent our $24. Now, let's hit the fast forward button to the day these options expire and see how this whole strategy actually plays out at 3 different potential stock prices for Box.
This table tells the whole story.
Let's start at the top. If the stock finishes way up at $26, well, our bearish bet was wrong. Both options expire completely worthless. We're out our initial $24 cost, and that's it. That's our maximum loss. Now look at that middle row. What if the stock lands at $16? Hey, our plan is working. The puts we bought are now in the money, making us a profit big enough to cover our initial cost and leave us with a nice little $8 gain. But what happens in a crash? What if the stock plummets to $6? This is where the spread's design is so brilliant. Sure, the puts we bought are now wildly profitable, but that profit is offset by the loss from the puts we sold. So the final result, after you factor in our cost, is a $24 profit, our maximum possible gain.
So after walking through all those numbers and all those scenarios, what is the single most important thing to take away from a strategy like this one? It all boils down to this: a perfectly defined profile. From the second they put on this trade, the investor knew, with 100% certainty, their absolute best case scenario was a $24 profit, and their absolute worst case was a $24 loss. That is what a hedged strategy is all about. You give up that lottery ticket dream of unlimited profit in exchange for the certainty of a strictly limited risk. And that really leaves us with this central question, the one every trader has to answer for themselves when they look at a spread like this. Is that trade-off, giving up the chance for a massive home run in exchange for the comfort of knowing your exact maximum loss from day one, is that worth it? Your answer to that question really defines your entire approach to the markets.